So on this series, portfolio. So what is a portfolio? Bunch of stocks or a bunch of pairs. But to build this portfolio, you need to have some things inside of it. So we need diversification and correlation. Most important thing with any portfolio, it must have correlation in it to be successful. To do it successfully, apply the way we apply to make money consistently. It must have correlation in it, must have diversification. So whether if it's stocks, we use an option to structure the trades, but we still need to build a portfolio. So we still need to look for correlation within the stocks that we look in the trade. Nice, and then we diversify over different sectors, cyclical, defensive, etc. Nice, the mid caps, large caps, we look for that. Forex, same thing. We're looking at pound pairs, euro pairs, we're looking at majors. So we're looking at pairs that start with USD, X, and we're looking at X, USD. Why? They will have a negative correlation. So if Euro USD is going up, right, let's say Euro USD is actually going up, USD pairs, because it's a base currency, this is base, and this is the quote, alright, USD. Alright, this is the quote. So base currency, quote currency. So when the DXY is actually going up, the pairs that start with USD, you will see following suit. They will follow the suit and go up too, while the quote currency will be going downwards. That's where we get the correlation from. Alright, and vice versa. If we have Euro GBP and you use a GBP JPY pair, because it have a quote currency base currency relationship, you wouldn't find both of them moving together. You will find one going up while the other one coming down. So we need that for the market swings. Nice. Black swan event, we could hold with that. Anything that going in the market, any shift, anything, any news event, anything that has happened catastrophic in the world and shift the market, we will still be profiting. The market shift up or shift down. We need that to make that consistent money, preserve ourselves, hedge ourselves in the market. And when we do get the both directions right, the one that we expect to go up, and the one that we expect to go down, boom, home run. Bat it for 6. Yeah? So this is where we get the correlation from. And when it comes to diversification, it's just a simple fact of we take some USD pairs, and then we take some Euro pairs, and then we take some GBP pairs. Alright, so this is where we get diversification from. We're just taking pairs from different sectors, different category. So if news event come out and shift the USD pairs, it won't shift these and these. If Euro news come out and shift Euro, it may not affect these and these in no significant type of way. Nice. Pound pairs come out, pound news come out, it wouldn't shift the whole market in that type of way. So that's why we gotta diversify. Because if we only have USD pairs, if something wrong, if the USD news does something drastic, all the pairs in our portfolio is gonna rock. We want when USD news come out, even if it shifts this, it doesn't really affect those. We want when the Euro news come out, if it shifts this, it doesn't really affect those. And if pound news come out and does something, it doesn't affect the whole thing. So we never want all our pairs being affected in our portfolio at one given time, when every week we have GDP, PPI, CPI, FOMC, NFP and things coming up, right? Those things actually help us on those cycles you see in there. All that whole volatility run you see in there. So remember, we lean towards volatility. So that whole volatility run you see in there, all that is what news events make up on. That whole volatility run you see in with the 1, 2, and 3. Right? That whole thing is NFP, FOMC, PPI, CPI, all of that. So it doesn't really affect the direction that we are looking at. We are trading and benefiting from all that. We relaxed. We have our portfolio on. It's running for the next 2 weeks, 3 weeks, next month, month and a half, whatever. And it's just flowing. So when we look at diversification, this is what we're looking at. Correlation, we need the code currency and the base currency. So when we actually build the portfolio now, if we have 5 longs and we have 5 shorts, we're looking at them moving like this. Alright, we have 5 longs, 5 shorts. This is the 0 point. All the trades start in here. Alright, we got a 1 to 5. Our ratio, we're risking 10 to go for 50, 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 because we know we can catch that once we have that ADR. Nice, we can catch that. We have that ADR going up. Same thing with the bottom, 10 to 50. Nice, we got all the 50 mark here. Nice, and we got 10 exposed here. Alright, so we trade on a 0.01, 100 pip exposure, leave room for fluctuation. You have to leave room. It's not about perfect entry and tight stop loss. You have to leave room. It's like fire. You will never go close to fire. The market actually fluctuates. You have to respect the fluctuation and know that you can't go too close to price. You're going to get stop out, wick out, all the time. You have to understand, you must stay. The market is a fluctuating tool. You must stay a safe distance away. You will never go close to fire. You will sit down around a fire heat. Yeah, you get some warmth, but you won't go too close. Same thing in the market with the fluctuation. You understand the market fluctuates, you're not going to go too close. You got to go a good distance away and leave room for fluctuation. You want to stay in the trade until the market progresses. As you have the direction right, you're good to go. You're going to come out and profit in the next 2-3 weeks, in the next 2-3 days, whatever. But you cannot be looking at tight entry, perfect entry, tight stop loss, perfect direction for us. And we use a respectable, calculated control risk, and we put the trades on to do a thing. Nice. So that makes up the $10. Nice, and we're going for 500 target. So we're making $50. So what is our full exposure here? $50 longs, $50 short. We have $100 exposure. We have $1,000 capital. We take 10% out of that capital, where we get our $100 to now risk across the board. So we have $900 safe and sound. We can't blow that up. We can't lose that. Yeah. So this is how we line them up. Nice. They have the correlation. Even if we lose this one, lose this one, like $10 gone, $20 gone, $40 gone. If we hit this one, $50, we make back the $30 that loss here, and we still in $20 in profit. And we hit this one here, so these two correct, we still make a 50, we still make 70, we still in profit. And we lose majority of the longs. We lose 3. So we don't need a 99% win rate. Nice, and we don't need to win more trades than we actually lose trades to make money with what we actually aiming with these cycles and these levels and these comps. Nice. So even if we miss there and get through here, still make up for this. Sorry. This is the risk here. Still make up for that. Yeah. We get this one right, we get this one right, we get this one right. We're still in profit, still making money. Right? Even if we get all of them wrong, and just get this one alone wrong, we still make back the $40, we still end up with $10 profit. Even if we get this one wrong, this one wrong, this one wrong, this one wrong, and this one alone play out, we still, with this one alone, $50 in profit, we still make back our $40 and end up with 10, and we lose majority of the trades and still end up in profit. This is the framework to make your millions. This is the framework to make your money. This is the framework we has used on the inside of the industry, and retail traders are supposed to be used on the outside to really make money consistently in financial markets. You do not need to win all your trades. You do not need to win more trades than lose trades. You do not need a high win rate. 40% accuracy, you're doing well. 50%, you're still good. 60, 70, you're real bad. And you're making money all the time, even though you're losing trades all the time. It's inevitable, you're leaving room to lose trades, but you're making money consistently every quarter by applying this. Over and over. On the correlation and the diversification. Nice. And with your R ratio. And the trading them cycles and them levels on them. And watch the beautiful risk factor that you have that you can put in place, and don't expose yourself too much and still make money. Because just with $100 exposure, right, we know the risk of every single trade, and then we know the risk of our entire portfolio. Nice. We know the risk to reward of every trade, and then we know the risk to reward of the entire portfolio. So we get all these 5 here. Nice. We got 50, 100, 150, 200, 250. Same way with the law if we get a full home run. Nice. So we have 250 in the longs, 250 in the short. We get a full home run. We just made $500. We just made $500 from exposing ourselves to $100. That's a 1.5 R ratio. That is what we're aiming at. That's what we're aiming for. So this is the framework here. Let's give all a quick little scan through. If you like what you see here, and you think you can apply this, you think you can learn this, and you think it's going to work for you in financial markets, definitely. We're going to teach you all the different segments and aspects, train you, coach you, mentor you, give you the knowledge, understanding, and wisdom. Yeah, we're going to bless you and make you become a blessing to others. Yeah, we're going to show you how to do it properly, once and for all. Finally, somebody know the good stuff. So you don't need to win all your trades. Manage your risk properly. You have a hedge in financial markets. Get ready. Accumulate, accumulate, compound, compound. Accumulate, accumulate, compound, compound, and trust me. Game over. Welcome to Fishing with Cribs. Let's kill it in financial markets 2026.